Why should we have a credit crunch before they're forced to do more? We already know that the economy is weakening. We can quibble about the degree to which it is, and the labor market is obviously weakening too.
Scott, let's quibble, because I disagree. I think the economy is strong. I think the labor market is back to normal. It's not that it's cooled off, as Powell said. I think it's back to normal. And what's back to normal is, as evidenced by initial unemployment claims, have come down a bit here after they looked like they were going to go up. But again, a lot of that was weather related. The payroll numbers that we had at the beginning of August, that was weather related. And I think we're going to see stronger numbers there.
But if things are back to normal, the Fed funds rate is not. That's the whole point. If things are normalizing, but the Fed funds rate is still too restrictive, why shouldn't we move it back towards normal?
That's your interpretation. Well, Scott, that's your interpretation. My interpretation.
But how's it my interpretation, Ed? They hiked for 18 straight months.
Where's it written? Well, they hiked from zero. That's the point. That's why, I've been predicting no recession since the beginning of 2022, and everybody else has been predicting a recession. And one of the things I got right was saying, look, the Fed has tightened from 0 to 5.25%. So the abnormality was 0, not getting to 5.25%. By 5.25%, the economy is dealt with extremely well. It's been at these levels in the past, and the economy has grown. So I disagree with the view that the economy is weakening, that the labor market's weakening, that the Fed funds rate is too restrictive. But I'll go along here. I mean, look, what I say is irrelevant. The Fed is saying they're going to cut by 25 basis points, and that's what's going to be.
But I mean, job growth is slowing, and the unemployment rate is going up.
It's not slowing. It's normalizing. We're back to 170,000.
But now we're having a semantics debate, Ed. I mean, okay, it may be normalizing. Sure, it's normalizing. But it's to normalize, it's slowing. And the Fed doesn't want to lose control of it now after they've come this far.
Scott, it's slowing relative to a boom that we had in the labor market that has certainly simmered down. We're back to where we were before the pandemic in terms of the monthly increase in payrolls. And that was perfectly good time for the economy. The unemployment rate got down to 3.5% right before the pandemic. So
well, interest rates were at 0.
What's that?
Interest rates were at 0.
They were absolutely abnormal. Absolutely. And here we are back at 170,000 per month, as we were before the pandemic, and interest rates are 5.25%. And the abnormality was 0 interest rates, not 5.25%. But, I'm not saying we're not going to see the Fed lowering interest rates. I'm just saying it's I think they got too dovish and they're forecasting too much.
I mean, the abnormality was maybe getting to 5.25 as fast as they had to. I mean, they were forced to do that. That wasn't normal either because of the level of inflation we had, the highest in 40 years.
Yeah, but Scott, you agree with me that starting in 2022, as the Fed raised interest rates, everybody was talking about that's got to cause a recession. And we still don't have a recession.
Of course.
We still have 20 people talking about it. Yeah.
You are correct. Of course, most people thought that it was going to cause a much faster deterioration in the economy. But the long and variable lags have proven to be much longer than people ever expected they would be. But that doesn't mean you just declare victory and assume that all of this is going to work out and that you don't need to do anything with interest rates at this point.
I'm not declaring victory. I'm just saying that what economists missed is what I call the credit cycle, the credit crisis cycle. History shows that what happens is when the Fed tightens, you get a credit crisis, which turns into a credit crunch, which then becomes a recession, which is when the Fed lowers interest rates and rates decline sharply. And that's when you get your inverted yield curve, that when it starts to disinvert, that's when the recession actually hits. What's different this time is, yes, monetary policy tightened. Yes, we got a credit crisis last year, but the Fed came in and stabilized the situation. And guess what? We haven't had a credit crunch. We haven't had a recession. And I'm sticking with that story.